Good evening, everyone. Tyler's on assignment tonight. Well, what a difference a day makes. Stocks surged higher today, rebounding from Monday's sell-off. Investors were encouraged on news of stronger than expected retail sales in December, and that lifted shares of some of the nation's biggest chain stores. Also powering the rally, better than expected earnings from two of the nation's biggest banks, J.P. Morgan and Wells Fargo, and that gave a boost to financial stocks. We'll have more on those bank results in just a moment. By the closing bell, the Dow added 115 points. The Nasdaq jumped almost 70, regaining all of Monday's losses and more. And the S&P was up about 20 points. That's its biggest gain for the year so far. More now on J.P. Morgan Chase and Wells Fargo. Both banks posted quarterly earnings that beat analyst forecasts. J.P. Morgan earned $5.3 billion. Its net income would have been even higher if the bank didn't have to pay billions in legal fees and settlements for past wrongdoings. Profits at Wells Fargo, meanwhile, shot up 11% to a record $5.4 billion on a modest beat of $1 per share. Now, even though mortgage lending was cut in half due to rising interest rates, interest income from a boost in customer deposits rose sharply. The bank's chief financial officer is optimistic about the future.
What we're seeing is good growth reflecting an improving economy and our ability to go ahead and take share from many of our competitors.
Well, despite the upbeat comments, shares of Wells Fargo and J.P. Morgan were both relatively flat today. Now, tomorrow we hear from Bank of America, and then later this week, Citigroup, Goldman Sachs, and Morgan Stanley. Well, here to give us more analysis on those bank earnings and a look ahead to next week is Fred Cannon. He's director of bank research at the firm Keefe, Bruyette & Woods. So, Fred, let's start with J.P. Morgan. It's been going through a tough time. It had all those legal problems, settlements, write-offs. As you look ahead to 2014, are things going to be better? And what does it mean for the bank and the stock?
Look, I think on J.P. Morgan, things are going to get a little bit better, but it's still a tough road for them ahead. I think we have to look at the results today and say, yes, they beat, but remember, after the third quarter, earning estimates had come down for the company. So, yeah, I think it was a solid quarter. I think overall, though, a revenue environment for these big banks is still pretty challenging.
But you are recommending J.P. Morgan. It is one of the stocks on your buy list. If someone puts in fresh money at $57 a share, how will they do this year?
I think they'll do just fine. I mean, we don't think it's necessarily the biggest grower in terms of stock price across our universe, but it should be solid because what's happening is that the dark cloud that's been over J.P. Morgan for about a year and a half now is beginning to break up. It's not going to be clear skies, but it'll be less cloudy.
What about Wells Fargo? Clear skies for that bank? It reported a big drop in mortgage activity. What's the outlook there?
The outlook for Wells Fargo is to grow earnings 10% a year no matter what, and I think they proved that they could do it again. It's a very diversified company, very strong in the U.S. While it has the same issues in many ways as the big banks like J.P. Morgan, it has less of them and doesn't have those big derivative exposures that face increasing regulatory hurdles this year. So Wells Fargo should be just fine.
Give us a little bit of a preview of what to expect from some of these other banks. As we just mentioned, Bank of America reports tomorrow, Citi on Thursday. What's going to be the tone from their earnings? Pretty much the same of what we heard today?
I think they've basically gotten the estimates. The companies have kind of gotten analysts down to where they want them. After the third quarter, remember, earning estimates came down. Two reasons. Number one is what you mentioned, Susie, is mortgage. Under a lot of pressure as rates rise, fewer refinancing. Secondly, the capital market activity. Fourth quarter is never a big time for trading. A lot of guys go on vacation, especially with that Wednesday Christmas holiday. But I think expectations are pretty much in line with what they should deliver.
Tell us about Citi. It is on your buy list. Why do you like it at $54 a share?
We like it because it is building book value, and it's trading right at book value. It's excellent restructuring story led by this management team. They're reorganizing the company to reinvest where they make money, make it simpler, make it smaller, and we think they're going to get some good news from the government on capital return this year that should be a big benefit to the stock.
Now, you also like some smaller regional banks. It'd be nice if we can just go over those real quickly. You say that they have a lot going for them. We have a list here. Why do you like Signature and Silicon Valley Bank and PacWest? What's the upbeat on this?
We encourage investors to not look at those big banks because we think the banks under $50 billion in assets, not household names, but still very strong banks, as being where you can really get some revenue growth. Remember, those top top line guys, yeah, they're making money, but they're not really growing revenues. Signature and Silicon Valley Bank out in California, Signature right here in New York, they're growing loans 20% plus a year. You don't hear anything like that at the big banks, and so that's unique. Some other ones are Prosperity in Texas and PacWest out in California. They're able to do mergers and acquisitions that are very accretive to earnings.
All right, Fred, thank you so much. Always a pleasure having you on the program.
Great to be on, Susie.
Fred Cannon from Keefe, Bruyette and Woods.